Jai Hind, my dear students. Today we are going to start the revision section with a single video. You can do the maximum you can achieve from this examination. First term examination is coming on Monday. All of you please watch this video up to the end. Definitely you can score 40 out of 40. You know very well the pattern of questions. You know you have to attempt 45 questions out of 55 questions. You will get 40. And all the very best, my dear students, you can score. My dear students, you have to watch the chapters accounting for partnership fundamentals, then admission of a partner, from where you will get 18 marks, and accounting for share capital, you can score 12 marks, and from the remaining two chapters, you will get 10 marks. So, first of all, I would like to start from the area accounting for partnership fundamentals. You know very well the common meaning of the term partnership. You know it is a form of business organization which is registered under the Indian Partnership Act of 1932. And you know the features of partnership. There will be an agreement, number of persons minimum 2, maximum 50. There will be a written agreement, a deed. It's not compulsory, and they are doing legal business. Sharing a profit is maybe equally or in some proportion. There will be good faith between the partners. The liability of partners is unlimited, and also no separate legal entity. These are the features of partnership. And very important point you have to keep in mind, that is the rules applicable in the absence of partnership deed. You know very well, if there is no written agreement between the partners, partnership deed, what we have to do? For profit share will be equally. There will be no interest on capital given to partners. No salary or commission will be given to the partners, and also no interest on drawings will be charged. And you have to remember, if there is any loan amount, 6% interest will be given. And without the consent of other partners, there will be no one will be admitted into the partnership firm. So my dear students, please remember all these valuable points, and we can expect some questions based on that also. When we move to the final accounts of partnership, we have to remember very well the two methods of preparation of capital account of partners. Fixed capital method and fluctuating capital method. Fixed capital, why it is fixed? You know very well, two accounts are prepared. Fixed capital account and current account. Partners capital account and current account. So in capital account only capital amount is shown. Entire adjustments like interest on capital, salary to partner, commission to partner, profit and loss share, and also in the debit side, the drawings, interest on drawings. All these items are shown in the current account. That is why the amount of capital will be always fixed. So two accounts are prepared under the fixed capital method, and only one account is prepared under the fluctuating capital method. So you know very well all the items, opening balance and additional capitals, all the interest on capital and in salary or commission to a partner, then profit and loss, appropriation, share. All these things will come in the credit side, and in the debit side, normal items like drawings, interest on drawings, profit and loss, appropriation, share of loss, revaluation loss, all these items are coming. When we consider the capital account up to the admission of a partner, some more items will come in the credit side, like premium for goodwill, additional capital brought by the partners, accumulated share of profit or reserves, and also the amount of goodwill brought by the new partner will be shared between the partners, premium for goodwill. And in the debit side, there will be accumulated losses and also share of loss, revaluation loss also will come. Keep in mind all these points. And profit and loss appropriation account, you know very well, there will be two different words you have to keep in mind very well. That is charge and appropriation. You know, charge means an expense which will be debited in the profit and loss account, whereas here in profit and loss appropriation account, we are debiting all the appropriation given to the partners, like interest on capital, then in salary or commission to a partner, and also the reserve transfer. But in the credit side, we will transfer the share of net profit and also the interest on drawings charged from, means collected from the partners. So that net effect means the difference amount will be shared into their capital account. So appropriation, to appropriate the profit we are preparing. And regarding the fundamental area, we have to remember three important terms: manager's commission, rent to a partner, and interest on loan to a partner. All these items will come in the debit side of profit and loss account. Why? Because all these items are charge of the firm, not related to the partners. Kindly keep in mind, it is charge. And keep in mind the different method of calculation of interest on capital. Normally we will calculate the interest on capital, amount of capital into rate by 100. And if there is any additional capital, depending upon the period, we will add the interest on capital with the initial investment made by the firm. And if there is any opening balance is not given for the capital, only closing balance is given, then we have to keep in mind one thing, very, very important. Interest on capital is collected or given. It is calculated on the opening capital, not in the closing capital. So we have to calculate the opening capital through these methods. We have to add drawings with the closing capital. We have to deduct the amounts of profit or salary like that from the closing capital. We will get definitely the opening capital. If there is any additional capital, that must be deducted. So from that opening capital, we are calculating interest on capital. And we have to keep in mind the methods like calculation of drawings. Normally, we are calculating interest on drawings like drawings into rate by 100 into number of months divided by 12. If there is no particular date is given, we will take average period as 6 by 12. And also please keep in mind the interest on drawings for different other cases. If the amount is withdrawn per month, every month, if it is in the beginning, 6.5 is the average period. If it is in the middle, 6 months is the average period. At the end, 5.5 is the average period. And quarterly drawings, another important category. There, if it is in the beginning of the quarter, 7.5 is the average period. And if it is made for the middle, 6 months is the average period. And if it is at the end, 4.5 is the average period. So you have to keep in mind all these things, very, very important areas. And there will be another concept related to fundamentals, that is guarantee of profit to a partner. If the guarantee is given by the firm, first of all, we have to follow all these steps. We have to find out the amount of share and given guaranteed for the partner. And if there is any deficiency, and if the guarantee is given by the firm, that deficiency will be shared by the old partners in their old profit sharing ratio. And if the guarantee is given by the partners in a specified ratio, that deficiency amount will be shared by the partners in that particular specified ratio. If the guarantee is given by only one partner, that deficiency, that net amount will be deducted from that partner who given the guarantee. So that is very, very important area. And regarding the most important area where we can expect at least 2 questions, that is the adjustment. If there is some items it is not recorded, and how we have to find out the adjustment entry, single adjustment entry questions will be there. If the firm omits interest on capital to record the interest on capital or interest on drawings or salary to a partner, then how to record all these things you have to practice very well, very, very important area. And regarding the next chapter, admission of a partner, you have to keep in mind all these upcoming items. Regarding the admission of a partner, some important points are calculation of new profit sharing ratio, sacrificing ratio, valuation and adjustment of goodwill, and revaluation of assets and assessment, reassessment of liabilities, distribution of accumulated profits or reserves, etc. So, new profit share is calculated. New profit sharing ratio is calculated to find out the new profit sharing ratio between the new partner after the admission of a new partner. You know very well, after the admission of a new partner, there will be lot of changes. The already remaining old partners will surrender or sacrifice something. So we want to know what is the new profit sharing ratio. And sacrificing ratio we are calculating using the equation old ratio minus new ratio. It is to find out and also to share the important item, goodwill. You have to keep in mind the equation sacrificing ratio, and you know very well at the time of admission the firm will re-evaluate the assets and also reassess the amount of liability to find out if there is any profit or loss on re-evaluation. And this is the account. You know very well in the sample question also, one question is there. They are not asking directly the amount of revaluation. They are asking what will be the reassessed value of some items. They will give lot of information, but we have to practice very well And also kindly keep in mind the format of revaluation account. Increase in asset, decrease in liability, unrecorded assets are coming in the which side? Credit side. And in the debit side, decrease in asset and increase in liability and unrecorded liabilities are coming. If there is any profit, that will come, revaluation profit come in the debit side and the revaluation loss comes in the credit side. That will be transferred to partners' capital account. And also you have to remember the adjusting entries regarding the accumulated profits, losses and reserves. And you know very well the common important items like general reserve, profit and loss, credit balance, workman compensation reserve, investment fluctuation reserve. It will be shared to the old partners in the old profit sharing ratio. That is a key point you have to remember. Old partners, old profit sharing ratio. And next there will be some losses that will be shared between the partners using this entry. Old partners capital account debtor to profit and loss debit balance to advertisement suspense to deferred revenue expenditure. So that is the thing regarding adjustment. And you have to keep in mind the very important area, goodwill. Goodwill calculation methods you know very well. Very important methods are there. Average profit method, where we will calculate the average of past few years and we will calculate the amount of goodwill is equal to average profit into number of years of purchase. And super profit method is there. You know, super profit equation will be average profit minus normal profit. How we can calculate the normal profit? Normal profit is equal to capital employed into net rate of return divided by 100. And the difference between average profit and normal profit will be super profit. Goodwill is equal to super profit into number of years of purchase. Also there will be another methods like capitalization of average profit and capitalization of super profit. You know very well the calculation of goodwill using capitalization of average profit method. You know, capitalized value of average profit we have to calculate, and also capital employed. Goodwill will be the difference between capitalized value of average profit and capital employed. And capitalization of super profit method, there will be goodwill is equal to super profit into 100 divided by normal rate of return. So my dear students, very important area. Definitely 2 or more questions will be there from this treatment and calculation of goodwill. Treatment of goodwill you have to remember when the new partner brings goodwill in form of cash. Entry you know very well. The amount of goodwill brought by the new partner will be shared between old partners or sacrificing partners in their sacrificing ratio. That is one treatment that will come in the credit side of capital account. And another treatment it is what? If the partner does not bring goodwill in the form of cash, that will be adjusted through the current account. Entry will be new partners current account debtor to sacrificing partners or old partners. So there will be also we are sharing the amount of goodwill with the sacrificing ratio. So kindly keep in mind all these points. That are the 2 different chapters where we can expect 18 mark questions. And very important area, accounting for share capital. You know very well the different concepts of authorized capital, issued capital, sustained capital, called up capital and paid up capital, and also uncalled capital. You know very well the concepts, and we have to remember the journal entries on application, bank account to share application, then if it is transferred to share capital, share application to share capital, any amount refunded, share application to bank. And regarding the allotment, the basic entries are share allotment to share capital, due entry, then share application to share allotment, excess application money adjusted in allotment, and bank account to share allotment when we receive the amount. And regarding the call money, the remaining amount when we are receiving through the different installment, if it is due, share first or second and final call accounted to share capital. When we receive, bank accounted to share first call or share second call and final call. So my dear students, these are the basic entries, and you know very well the concept call scenario, and definitely it will be debited. Call scenario will be debited. Bank account debtor, call scenario account debtor to share allotment or to share first call, to share second call, like that. And regarding calls in advance, it is always credited. So bank account debtor to calls in advance, to share allotment, to share first call, like that entry will come. And also you have to remember oversubscription. We have to treat the oversubscription in 2 different ways, either by rejecting or by prorata or the combination of these two. You know, rejection entry, share application to bank. And the things you have to remember regarding pro rata, you know very well the concepts of pro rata allotment entry, you know very well, share application to share allotment. A proportionate amount of shares will be given to the persons who are applied some 20,000 shares will be given to applicants of 30,000, like that. So you have to keep in mind the entry and also the calculation. There will be one question regarding that area. Very important area is over subscription. No need to give much importance for under subscription. Under subscription, there will be little number of shares will be applied by the public. More maybe the number of shares issued will be high and the applied way will be low. And a very important area, issue of shares at premium. You have to keep in mind issue of shares at premium. That excess premium amount will be transferred to securities premium reserve. You have to keep in mind all these journal entry regarding premium. And you have to keep in mind issue of shares consideration other than cash. Definitely there will be one question regarding this area, and you have to keep in mind the concept of calculation of number of shares issued to the vendor. That is the thing you have to keep in mind regarding this area. Kindly remember the entries: assets to vendor, vendor to share capital. There will be par, premium and discount. Then you have to keep in mind the entries related to discount and premium. Also there will be shares related to what issued to the promoter, promotional expense accounted to share capital, and also the shares issued to the underwriter, also very important area. And last areas in this chapter is for feature of shares and journal entry. You have to remember regarding the cancellation of shares if one is not able to pay the full amount of calls. So share capital to share forfeiture to share allotment to share calls. That is a very important area, but you have to keep in mind the question they are able to ask. There's a possibility like that. What is the amount of money debited in share capital? At that moment, you have to keep in mind the two important points. One is what is the face value of share issued, and if there is any word like called up capital. If there is any word like called up capital, face value is 10, called up capital is 8, definitely number of shares into called up capital will come in the debit. And regarding another concept, if the shares are issued at a premium, at the time of cancellation also, we have to debit the premium amount. Please use this journal entry: share capital account debtor, securities premium reserve account debtor, to share forfeiture, to share allotment, to share calls. So very important area. And the last concept in shares is forfeited shares will be reissued. Entry will be bank account debtor, share forfeiture account debtor to share capital. If the shares are reissued at a discount, if it is reissued at a par, bank account debtor to share capital. If it is reissued at a premium, bank account debtor to share capital to securities premium. And very important area, you have to calculate and practice maximum the amount of money that will be transferred to capital reserve. So kindly remember the shortcut. What is the amount of money credited in share forfeiture minus debited in share forfeiture into number of shares reissued? That is a shortcut you have to keep in mind. So my dear students, another important area, financial statements of a company, and you have to practice financial statements of a company, the different headings and subheadings coming under each area. Okay, so you have to keep in mind what is financial statement, and also the two items coming under financial statement: balance sheet and statement of profit and loss. You know the headings and subheadings coming under the vertical form of balance sheet. The first side it will be equity and liability, and second side it is asset. All the things you know very well, but remember what is the headings and subheadings. Shareholders fund, non-current liability. Current liability are the headings, subheadings will be there. Shareholders fund includes share capital, reserve and surplus, money received against share warrant. And in non-current liability, you know, non-current liability is for a long-term obligation that will be repaid after 1 year. And it will include the items like long-term borrowings, deferred tax liability, other long-term liability and long-term provision. And regarding the current liability, you know very well, current liabilities are the amounts which will be repaid within 1 year, and the items coming under current liability are short-term borrowings, trade payable, and other current liability is also short-term provision. So these are all the things regarding equity and liability. And assets, you know very well, these are all the properties of the organization, the resources of the organization, which may be classified into non-current and current. Non-current will include fixed asset, again classified into tangible, intangible, capital work in progress, intangible assets under construction. Non-current asset also coming under that category. Deferred tax asset is there. Long-term loans and advances given by the firm to outsiders. Other non-current assets coming under non-current asset category. And in current asset, current investment is there, inventory is there, trade receivable is there, cash and cash equivalents, short-term loans and advances is there, other current assets are coming. So my dear students, please remember all these items. And in statement of profit and loss, in simple words, we can say the first part it is related to revenue, and another aspect is expenses. When the difference comes, it will be either profit or loss before tax. So that's all regarding the financial statement. And you know the tools of financial statement, you have to remember comparative statement, common size statement, and accounting ratio is there, cash flow statement is there, trend analysis is there. But the question we can expect regarding the vertical form of analysis and the horizontal form of analysis. So in vertical form of analysis, you know very well, vertical form of analysis include common size statement, accounting ratio. And in in the area regarding the horizontal form, comparative statement, time series analysis there, you have to keep in mind. And accounting ratio, you know very well, accounting ratio, it is the mathematical expression of some numbers. It may be in different categories like liquidity ratio, solvency ratio, activity or turnover ratio, or profitability ratios. We will go one by one. Okay, so liquidity ratio include two different items, current ratio and quick ratio or liquidity ratio. You have to keep in mind current ratio, equation will be current asset divided by current liability, and 2:1 is the ideal current ratio. Working capital ratio is another name for current ratio. And quick ratio, you have to think about quick ratio, liquid ratio, and another name is asset test ratio. Equation is quick asset divided by current liability. We can keep in mind what 1:1 is the quick ratio. Kindly keep in mind 1:1 is the ideal ratio. But while calculating quick asset, keep in mind we have to deduct prepaid expense, advance tax, and the stock from the amount of current asset. Okay, so that are the things you have to keep in mind. Quick ratio. And solvency ratio includes debt equity ratio, then proprietary ratio, total asset to debt ratio, and interest coverage ratio. Debt equity ratio equation is debt divided by equity. 2:1 is the ideal debt equity ratio. Proprietary ratio, shareholders fund divided by capital employed, and also total asset to debt ratio is there. Total asset divided by long-term debt, and interest coverage ratio, net profit before interest and tax divided by interest on long-term debt, and also activity or turnover ratio include inventory turnover ratio. Equation is cost of revenue from operation divided by average inventory, and trade receivable turnover ratio is there. Net credit revenue from operation divided by average trade receivable. Trade payable turnover ratio is there. Net credit purchases divided by average trade payable, and net asset to capital employed ratio. There we have to remember working capital turnover ratio. Net revenue from operation divided by working capital. Then profitability ratios we have to remember gross profit ratio. Gross profit divided by net revenue from operation into 100. Then operating ratio is equal to cost of revenue from operation plus operating expenses divided by net sales into 100. Then operating profit ratio, simply we can calculate 100 minus operating ratio, or operating profit divided by net revenue from operation. Net profit ratio is equal to, very simple one, net profit divided by net revenue from operation into 100. And last, very important, return on capital employed, ROI, or return ROCE. Equation is what? Profit before interest and tax divided by capital employed into 100. My dear students, thank you for watching the entire video. I wish you all the very best for this exam. Definitely you can score 100 out of 100, means 100%, 40 out of 40. All the very best. Our prayers are always with you. Thank you. Kindly continue to subscribe my channel for the second term videos. Thank you.